Eric, it's only fair if we talk about the market-free annuity disadvantages.
But we're annuity guys. We can't talk about the disadvantages. People will find out they might not be perfect.
Well, they might start thinking of us as being fair and balanced.
Oh, no. We wouldn't want to confuse the issue. And there are disadvantages. And usually the first thing that I think of is that most of these annuity contracts are long-term commitments. It's not uncommon for you to see 10 years as being kind of the standard bearer for this type of annuity.
Yes.
They have 15, 16, I've even seen 20 years out there.
Right, which we don't really like as a,
Not my favorite. I would rather stick to the shorter period, but you know what? They get the best benefit for the client, and this is typically a long-term retirement.
Well, exactly. A retirement is a 20 to 30-year proposition. So if the annuity isn't good for that length of time, it's worthless to begin with. So having some type of a reasonable surrender period is acceptable, normal. And yet,
not an advantage, though.
Not an advantage. It is a long-term contract. You have to go into this with your eyes open, doing sincere, serious financial planning.
Yes. Now, and you also know that we've talked about the fees and liquidity issues.
Yes.
Well, they have options, but you don't have 100% liquidity. It's not like walking down to the money market account and saying, "I want all my money now," without penalty.
Right. You've got. We've already discussed that you've got certain amounts you can take each year. And that, if your heirs receive it, they can receive the full amount without penalties. But there really is the aspect.
And that depends on the contracts. We should always say each individual annuity is going to have different liquidity provisions, but there is a chance. Typically,
they will. But you're right.
And the other thing is, we always talk about getting the market gains. Mm-hmm. We don't want to oversell it. You're not going all the way to the top every time.
Exactly.
Each of these annuities tends to have a limiting provision, either a cap or a participation rate.
Spread fee.
They could use a proprietary index that may allow them advantages on the insurance side, but may limit what the S&P is getting on the top side.
So. And we should also say that there are certain market-free annuities that are geared more to growth, and some that are geared more to income, and some newer innovations that have come along that have made it the growth aspect of a lot better potential.
Yes, a lot better potential, but still you're not looking at, if the market is going up 50%, you're not going to get the whole.
You're not going to get it all. So if you see the market jump 10, 20% in a year, which it does, occasionally.
You're only getting a portion.
You're going to get a portion of that, but you're going to have no loss to principal.
Right now, we've talked about a little bit about the guarantee side of the state guarantee. Mm-hmm. You got the state guarantee associations, so we don't have FDIC insurance.
Correct. No, you don't have the backing of the federal government.
Right.
And some folks would debate that. What's that worth? But
is that a good thing or bad? No, but we have to assume that that's the best.
It is the
backing that we have.
The best throughout the world. It's the bedrock of the financial community. Throughout the world.
So instead of having that, you do have each individual state typically has a state guarantee association that these insurance companies participate in.
Right.
Now, the biggest problem is it differs.
It varies, yes.
Every single state.
So you got to really check out your state and then realize that this is not the
It's not the bedrock. It's not like the FDIC.
And it's not even the basis that you should make your overall decision on. It should be based on the claims paying ability of the company that's issuing the annuity.
Exactly. So you have to check it out.
Yes.
And the insurance company's got to be first and foremost.
The other thing, Eric, that can be a negative, and that is that some of these will have fees.
And we should say some of them. Not every version of a market-free annuity has fees, but the more benefits that you typically add on to annuity, income riders most of the time are going to have a fee associated with it, or a spread, or if you're adding a home health care double or a health care provision or long-term care, they can have fees associated with it.
So in general, we think of fees in a negative way just because it's a fee. So you have to at least say it is negative because it has a fee.
Right.
On the other hand, if it's relevant, if it meets your retirement priorities, the fee can be worthwhile.
If it's a value added and it means something to you and you're getting what you're paying for, then it has value.
Yes.
So it is a disadvantage if it comes money out of your pocket, but it can guess technically be an advantage, but I shouldn't say that because we're in the disadvantage.
That's right. So how have we done, Eric? Have we covered the disadvantages?
Oh man, we've really beat this up. Hopefully you understand that these are not the perfect instrument, and there is no perfect annuity. They do have disadvantages, but we are still the annuity guys.